Hello everyone, welcome to Bald Guy Money, and on September 8th of last year I warned you all that there was limited time to prepare yourselves for the next move up in precious metals, citing a similar warning I had given on the channel July 9th, 2023, when I said I was selling my stocks and running to gold. Now, I don't make these types of videos often and I don't make these claims lightly, but I feel the need to do this week because not everybody has treated these warnings seriously in the past. And it is becoming clear to me that a growing number of people don't really understand what is happening on the market right now, many of whom, and maybe some of you watching are in this group, started investing in 2020 or 2021 and think that the bad news we are seeing in the economic data we're getting out right now is great and that the market is going to be saved by it because the Federal Reserve will not allow markets to crash. So buy up stocks now because they're going to the moon. Now, as much as I am open to hearing differing opinions on this topic, the fact is, if you've been investing since 2021, you have 17 years less experience in investing than I do, and 79 years less experience than Warren Buffett, who, via his company Berkshire Hathaway, has been selling stocks since the second quarter of 2024. And although I don't agree with Mr. Buffett on some topics, specifically the topic of gold, and I admit he has been the longtime beneficiary of information people like us do not have access to, and yes, that means insider information, it is clear we agree on a couple fundamental things, and I don't think his retirement from Berkshire Hathaway, which he announced yesterday, is just random timing. So in this video, I want to cover three very important topics, starting with the major warning signs we are seeing from investment world insiders when it comes to the stock market and the health of the US dollar. Once that's covered, I want to explain why I think we may only have 4 months until we see the next big move up for gold and possibly a breakout for silver above $35 an ounce, and we're going to review affordability figures in that section of the video. So for those of you who like those stats, I will cover them there. And we'll finish this video with the topic of revaluation and what role it plays in these assumptions, as well as Basel III, which comes into effect in July of this year in the United States, and how it may be driving rumors of a US Independence Day gold revaluation. So be sure to watch to the end of this video for that. Now, just before we dive in, please remember to check out www.summitmetals.com to join the growing number of my viewers who have been telling me in the comments section of my videos that they have become satisfied customers of Summit Metals. And if you're new to Summit, remember to take advantage of the 5 ounces of silver at spot deal when you use code NEWCUSTOMER at checkout. The link to this deal is in the video description below. Okay, so jumping in, what are insiders telling us about the market? Well, as I've already said, I don't think Warren Buffett's retirement timing was purely coincidence. He's been selling stocks with Berkshire Hathaway for the past year, a clear indication that he thinks the S&P 500 is overpriced. And yesterday, along with his retirement announcement, he dropped a currency bombshell, admitting that he isn't as confident in the US dollar as he once was, hinting at his expectation that more devaluation is on the way. And Buffett isn't alone in this gloomy outlook. Insider stock transactions of $100,000 and above, so here we're talking about big transactions, continue to favor the sell side. And the largest stock purchases we've seen recently are into diversified dividend funds or bond funds, which are clearly defensive plays and show us that big money, smart money, whatever you want to call it money, is not buying this dip. In fact, if we look at some of the details of the most transacted stocks and highest trade values of the last 60 days, you can see that some of the names that are being bought up on the market right now by regular retail investors are being dumped by insiders, including Meta Facebook stock, which has been sold 16 times by insiders in the last 60 days with no buys made, as well as Walmart, which is up 12% over the last month, even though insiders have sold nearly $530 million worth of Walmart stock. So if you don't get what's happening yet, let me put this in the simplest terms possible. This is your December 2021 moment. The big guys are taking their chips off the table because they know the stock market isn't like gold and that rates coming down aren't a saving grace that immediately propel it to new highs, which since 2000 has been the case with gold, as I covered here last week and in some other recent videos. The stock market, and we'll use the S&P 500 as our benchmark, usually experiences a prolonged flush out, a bear market following rate cuts. We saw it in 2000 with the dot-com bubble, we saw it in 2008 with the financial crisis, and the example I use is interest rate cuts are like a parachute. And for gold, that parachute works almost instantly. But for stocks, it doesn't start to work until you get close to the ground. And although it is true that the 2020 crash was short-lived, and this is the example many newer investors cite as being their reason for calling the bottom in the stock market right now, the fact is that personal savings rates were high in 2020 and 2021 because for the first time ever, most of the world was told to stay in their homes, and their gas money and their restaurant money and their other disposable income found its way into the stock market via mobile apps like eToro and Robinhood. But as you can see in this data here, the personal savings rate is below 4% in the USA today, and that's versus 32% at the high in 2020 and 26% at the high in 2021. This is not the same situation. And with insiders positioning themselves for safety, which includes gold's major run-up in price this year, and Warren Buffett saying yesterday that the volatility we've seen over the past 30 to 45 days is nothing, it tells me that we're only at the start of something bigger, which is also confirmed by the negative GDP read we saw in the United States, which was released this past week, for a period that doesn't fully factor in the most recent global economic turbulence, the lasting impact of long overdue US government layoffs, which were skewing numbers to the upside in 2024, or recent layoffs in the trucking and shipping sectors, which in general are a strong sign of economic slowdown. Now, I've spoken about metals becoming unaffordable for the average person a few times here on the channel, and according to these latest figures, which I updated just today, that level of unaffordability hasn't changed, with the median US household only able to save about 1 ounce of gold per year, which is down from 6.6 ounces in 1990 and down from 2.1 ounces in 2011 when we were still reeling from the consequences of the global financial crisis and we experienced the last blow-off top for precious metals. And when we look at silver, those numbers haven't changed much, with the median US household able to save about 98 ounces of silver per year as of today's numbers, which is barely anything compared to the more than 500 ounces they were able to save in 1990, and almost equal to what they could save in 2011 when the average silver price was at a record high, and this is precisely why I am warning everyone right now in this video. Because we've only gotten a taste of lower interest rates and the accompanying weaker dollar that comes with lower interest rates. But with the market now expecting to see 3 to 4 US interest rate cuts in 2025, which is up versus 1 or 2 where we started the year, it's becoming clear that the script has changed. And what looks like minor economic weakness today can become an emergency very quickly, warranting more cuts, just as we saw earlier in the week when the odds for rate cuts spiked with the bad GDP data, but then came back down again with the latest US jobs report, which said the US added 177,000 jobs in April, with the market totally ignoring the downward revision of 58,000 jobs that were reported but never existed in the months of February and March. And as that plays out, as I've warned before, gold and silver will move in the opposite direction of a weakening dollar, just as we've seen recently, and the dollar has a lot of room to move down, making the reality we've seen in other parts of the world, which is wildly high gold prices and new record nominal high prices for silver, even higher than the 2011 blow-off top price, a US dollar reality. So, with us entering a traditionally slower period for precious metals due to lower demand from markets like India and China, where wedding and festival seasons drive purchases in other periods, as well as reduced investor activity known as the summer doldrums, I see the next 4 months as opportunity for gold and silver stackers. A period where, as you can see on the chart here, showing the price seasonality for silver from 2022 to 2025, may create buying opportunities or at least result in prolonged price consolidation at current levels, allowing you to stock up if you feel like you're falling behind. But why I say you have 4 months and suggest to use them wisely is because that is the period of time leading up to September, which has historically been a very good month for gold, as you can see in the image here. But more importantly, September 2025 will also mark the 1 year anniversary of the Federal Reserve's first rate cuts, opening the door to more cuts, maybe even at a faster pace, depending on what GDP and unemployment figures show, and I have no reason to be optimistic on those figures as things stand today. So, before we move on to the July revaluation topic, just know that you have at least May and June, if not July and August, to build your position in precious metals, and use that time wisely if that is, of course, in line with your strategy, because I expect the last 3 months of 2025 to be big for gold and silver, especially as rates start to come down in line with market expectations, including a move to $40 per ounce for silver. Okay, so with that covered, it's now time to move on to this video's viewer question. And please remember, I pick one viewer question to appear in every single video that I do. Don't be shy, submit your questions in the comments section of my videos, and I may pick your question to appear in my next video. And this week's question comes from Bookmarked9771, and he or she asked, when do I think a gold revaluation will take place? And to what level do I think gold will be revalued to? And he or she also mentioned July 4th, US Independence Day, as being a possible timing for that gold revaluation announcement. So let me start this off by saying that I think a revaluation of gold is going to happen. And it's not going to be because politicians have a sudden realization that gold is money. They're not going to be walking around quoting JP Morgan saying gold is money, everything else is credit. That's not why. The real reason is because their appetite for spending is growing. And that is highlighted by this article here that covers the European Commission's exploration of ways to channel 10 trillion euros in what they call unused savings into funding defense and economy boosting activities. Because, of course, if you don't trust the government enough to buy their bonds and lend them money on your own volition, on your own free will, well, it seems they're determined to get their hands on that money anyways. Now, as I touched on in a March video, revaluing gold reserves would be a way for governments, including the US government, to issue special gold redeemable bonds, meaning if the government can't pay you back with dollars they can just print, then you get gold in exchange. And it sounds silly, but by issuing these gold-backed bonds, not only will it unlock a new source of money for governments, but it will also decrease the interest rate they pay borrowers because the debt has the gold backing it, so it's deemed safer by the market. And considering the fact that US interest payments on the national debt are already above $1 trillion, that's something the United States and other countries want to tap into. Now, what about that July date? Could we see it happen that soon? Well, as many of you know, Basel III's reclassification of physical gold as a Tier 1 asset starts on July 1st, 2025 in the United States, and it has the potential to increase demand for physical gold beyond what we've seen so far this year, which would drive prices up further as banks prioritize physical gold over paper gold for regulatory compliance purposes. And this story is completely true. It's not a conspiracy theory. It's not bad information like I've said in the past that other channels have been spreading about the BRICS unit currency, which has been debunked 2 years in a row now, or Saudi Arabia totally turning its back to the United States. Basel III is a fact. Now, could we end up seeing a major institutional level buy the rumor, sell the news event in July? I don't rule it out. considering the fact that gold prices have already risen more than 23% in 2025, some speculative profit taking may occur once Basel III is implemented, so be aware of that. And for that reason, I think a gold revaluation will likely take place after Basel III is completely implemented, and that the soonest we may see any form of a gold revaluation, once again triggered by the introduction of gold-backed bonds, would be in 2026 once the gold market has stabilized a bit. At which point, I think we will see a mark-to-market model implemented, likely rounding up to the closest $100 price point as the value of gold backing these potential gold-backed bonds, putting a solid price floor under that number, which, if my projections from early 2024 come true, and please note that so far gold has exceeded those expectations in 2025, it would put us very close to the $4,000 per ounce price for gold, as my estimate is closer to $3,800 considering the price projections you see on the screen, and would only further justify central bank gold buying, solidifying it as a long-term trend, as it would provide the central banks and the governments of the world they are connected to more maneuverability to manage their reserves and even monetize them. Which also means that the countries I have identified as being underweight on gold, and even in some instances not having any gold at all, will have some major catching up to do, which is just one reason why I remain extremely bullish on gold at this moment in 2025, and I will use this opportunity to remind everyone that the country I was born in, Canada, has no gold at all. Well done, Canada. Wishing you all the best. Anyhow, with that said, bookmarked. I hope that answers your question. Thank you very much for asking it. So with that said, that's it for this video. I thank you all very much for watching. If you enjoyed the content, please remember to leave a like. If you think that somebody in your life needs to hear this message, please don't be shy. Share it with them. That is how this channel grows. And as I say at the end of all of my videos, please take care of yourselves and take care of each other. I do think things are going to get a bit tough still this year, so that taking care of each other part of the message is going to be particularly important. I'm wishing you all a fantastic day ahead. See you in the next one. Goodbye.